Good evening, good morning, good afternoon, whenever you're listening back to this. Welcome to this ACCA Advanced Audit webinar, specifically covering financial reporting. My name is Aaron Westgate. I'm one of the tutors at First Intuition, and I teach audit all over the place. It is my favorite topic. So one of the bits that people struggle with is financial reporting. So I thought I'd cover a webinar that covers the full span as much as possible in that hour time frame of what financial reporting you need to know, where it comes up, and some examples of how to approach those questions. So on to the next slide, please. What do you need to know? How might you be assessed? How might you approach it? Those are the three things I thought were important to cover, but always will accept questions and anything else we might digress to. But I think I've managed to get it down to about 47 slides. So that's about one slide a minute potentially for this day. So we'll cover that. Obviously, I'm not allowed to be an ACCA examiner, so this is my interpretation of that and how we approach it, and looking at examiner reports and speaking to the ACCA and all these other things built into one, which will hopefully get you there. So what I don't want to cover because of timing is the professional skill marks that get associated with it, because that's a whole different thing. How to achieve those materiality marks in risk questions. Again, that's examiner report covers that pretty clearly. How to write business risks, because they are not relevant for what we're talking about. And every type of financial reporting question you could come across. I've covered the main ones and the main types and examples of those, but this should cover a lot of it. But you have to be ready for the variation you might see in those questions. So first up, what do you need to know? I'm not going to cover loads and loads of detail, but I picked out two examples for financial reporting that I thought might be helpful because they're a bit more complex, and I want to bring them down to a level where it feels like anyone could almost pick that up. Okay? So in AAA, the big jump you see is you've learned financial accounting and you've done AA. So great, you've done provisions, you've done bits on non-current assets, you've done inventories at the lower of cost and NRV. That kind of stuff can be brought up to AAA, but it's not that likely. They can twist it a little bit and they can give you things like an insurance claim and how that affects it, or they could give you a decommissioning provision, which is a bit more complex, but those aren't as likely to be tested. If they do come up, then fantastic. But what you're going to see is a big jump in financial reporting. So you're going to have and consume all of financial reporting and all of SBR. Okay. Now, the actual topics you cover at SBR, there aren't loads more, but in terms of the depth of knowledge and some of the complexities you cover, it does leap up a little bit. Okay, and that's where there's a document that's really helpful called the examinable documents. But the things that are more likely tested, the things that are new in particular, that if you look at that examinable document, is employee benefits, so like share-based payments as part of that, pension schemes part of that, related parties, which we also covered in AA anyway, but they can be a bit more complex at advanced audit. Operating segments, which I'm going to cover tonight. Joint arrangements, which I'm going to not cover tonight, but I'll cover investments. And then there's some other bits, but they aren't really that examinable. They certainly could be tested because they're on there. Okay, they could test different financial reporting standards and tell you they operate in a different country and what those standards are in those countries, but that takes quite a bit of time. They want to stick to the syllabus as much as possible and some of the more complex areas you might see. But these are the jump areas that you can have in that syllabus, all covered in this document. So if you search for ACCA examinable documents, you'll find this one relating to your exams all the way up until June, this last sitting that I'm talking about. And each one has a tick box as to whether it relates to just FR or SBR as well. So it's quite a useful one for you to see. So you can then, particularly if you haven't done SBR, then you can see what things you might need to place a bit more emphasis on reading some notes around. But what do we think is a bit more examinable is slightly different. And the things that bring complexity are assets, but we're not just talking about a non-current asset. We're talking about held for sale assets, right? We're talking about discontinued operations. We're talking about slightly more complex assets with investments included within that. So slightly more complex scenarios, but the main principle behind it is the same. And obviously what quite nicely links with that is leases and sale and leaseback, which we cover a tiny little bit. Share-based payments, employee benefits, including pensions, very examinable. Okay. Deferred tax, very examinable. Again, I'm going to cover both of them in a minute. Business combinations, okay, so buying a company, splitting the company up, whatever it is, and discontinued. Revenue recognition, which I think is a pretty good one. It's a really common one because there's so many companies where their revenue splits over different parts of the year. They can't recognize the full revenue until something switches over. Okay. So things like that, again, are pretty common. And then related party transactions again, but in a slightly more complex scenario than you might have seen at AA. So it's good to see it all on one page. Okay. It's good to see it. But just as some examples that I thought I might cover. Share-based payments. Sounds a bit scary. It's not as scary as you think, particularly when you're auditing it. It's not actually as scary. So when we look at share-based payments, all it really means is a payment in the form of shares, whether that's now or whether that's delayed in some way. There are two ways we can look at it. So we can talk about equity, where it's offering shares or share options, or cash settled, which is basically using the share price as a way and a method of payment. Both of them have a fair value and both of them have subjectivity within it. And one of the common ways they assess it is by saying the company has offered a share-based payment scheme for employees if they want to take it up. Okay, and then they give you some values around it and so on. And I'm thinking like red flags, there are some risks there. There are some things I would test, and there are elements where I think, what would I expect to see on my audit file? And so when I do this, I do some annotations really quickly to say the fair value is going to be an assessment. Where am I going to get the fair value from? So whether it's a risk that the fair value is wrong, or a test that where would I verify that fair value? Is there a market price? What documents? Have they got some kind of independent expert in or something like that? There's going to be a judgment or some kind of documentation around it and reason. So if it worries me, if it's complex, if it's subjective, then I'm thinking there's a test or a risk. And equally with the employees, it's a choice. It's a share option scheme. So I'm thinking, well, how many people are going to take it up? How many of them are going to leave before they take it up or not be eligible? How many are going to vest? And then they have to spread that amount over the vesting period. So that's a choice. How long is that vesting period? Again, that's potentially 4 different tests back to back. And that would potentially get you a pass on any different share-based payment scheme and test. So that's a bit on share-based payments. The other one I wanted to cover was deferred tax. Again, always feels scary, but it literally is a tax that is deferred into the future, whether it's an asset or a liability. So it is a temporary difference. So it's a difference between how we as accountants in our accounting world assess it and how the tax regulator, I won't use the word taxman, okay, but tax regulator assesses it. So the difference between that is going to create an asset or a liability. Again, the ins and outs of it, I can unpick by thinking about, well, what goes wrong? Well, in particular, the tax regulator might have their own assessment of how much tax they owe. So, bang, review correspondence from them. Okay. Also, an asset in particular is one where there's more subjectivity. Why? Because you need to have future profits in order to absorb and offset. Okay, so that means, how am I going to know that my client in 3 years' time has got any profits? Well, I need to review a forecast profit or loss from them. Okay, I need to review something that they think demonstrates they're going to have profits in future. Otherwise, they can't recognize it. So again, it's a subjectivity and it's something that's a bit complex. So those are 2, as I said, I want to cover really, really quickly. But that's the real summative detail. And the examiner would give you something on it. They wouldn't say, test deferred tax. They'll give you some blurb around it in the exam. So that's just a couple of introductions to FR, okay, or SBR stuff, should I say, any kind of financial reporting. But what you're thinking about is, right, okay, I've got financial reporting, I know some of it, I know a good amount, some complexities, but how and where could I be assessed, okay? In practically every question you get in the exam. Question 1, the big case study, question 2 or question 3, they could have a good and substantial financial reporting focus. So the 4 main areas that I class as risk questions. Question 1, case study, we are talking potentially around 25 marks that could be on risk. Number 2 is tests, and those could be tests on the back of that risk question, or they could be tests in both question 2 and 3. Okay, they usually refer to them as audit procedures, or what examination procedures, or some kind of other wording in question 2 and 3. But ultimately, we're talking about audit tests. The other ones, quality control. That is where the examiners flipped it around. Okay, these are questions where people struggle. Because in risk, we're telling them what could go wrong. In tests, we are referring to how we would test them. But when the examiner gives you part of the answer and says, is this enough? Then people almost can only think about what's in front of them. So that's where we'll talk about how do you approach those, because that is a question where the examiner's flipped it around, basically given you the answer and said, why is it this? Have I done enough? And then the final one is financial reporting, which almost always, okay, is where we're justifying, reviewing, giving whatever the audit opinion is, the effect on the report. And a lot of the time that is a financial reporting issue, but it could be some other things, which is a whole different webinar. So these questions, I've got a question for every single part of that. Okay, so let's go through that. Just double check. Yeah, cool. How do you approach them? Let's start with risks. These are always in planning. You are always looking forward and saying, what am I going to do in the future? Okay. Question 1, case study, risk, always there. But it doesn't rely on business risk. Business risks are about you putting the company's hat on. But when we talk about financial reporting, we are talking about risk of material misstatement and audit risk questions. Okay, those 2 types of risk questions. And what we're looking for is realistically what goes wrong. And it's going to be either a number is wrong, or a disclosure isn't there, or is inappropriate, insufficient, or something of that sort. And these are typically 3 marks each. Typically, some are 4, some are 2. Okay, not usually 1, because it takes a little bit of time to write about it. So you have to think, if you're going to assume each one's 3, okay, you need to then obviously prioritize what those are. So how do you write an answer? Very, very much the same. Explain the relevant part of your financial reporting. So explain the relevant part, okay? That doesn't mean download all the revenue recognition rules if there's only one area of revenue recognition that they might have got wrong. Then explain what they have done right or wrong. So what is the risk that's gone wrong here? What could have gone wrong? And then finish it with, therefore, and you can do this every time, therefore, there is a risk that profit, disclosures, whatever it is, revenue is understated, overstated, under and overstated, okay, or the disclosure is inadequate, something like that. It is methodical, okay, formulaic, that you can run through that profile each time. But there's a couple of extra, well, I say a couple, there's about 8 different things I've written down. There's a few extra things, right, that we need to bring into our answer. Number 1 is we need to comment on materiality. And I don't mean the professional skill and all that initial summative part of materiality, but make a brief comment at the start about how important is this item, because we are prioritizing our risks, which means you need to give an answer at the top 2 that are why these are really important ones, why are these the highly material ones, okay? And yes, I did say I wouldn't talk about professional skills, but you ding that bell. Then This is where the chunk of your answer comes from. Clearly outline the applicable reporting rule, right? Clearly outline the thing that's gone wrong. And then state the two things that have gone wrong. We love a bit of double entry. We know if something's wrong, something else is probably going to go wrong with it, okay? So there's going to be two things that you're going to say have gone wrong, okay? So it could be expenses and assets, and one might be over, one might be under, okay? Something like that, something's going to be wrong. So pick two and state, therefore, there is a risk that blah, blah, blah. What you also need to do in most cases is distinguish when something could have been wrong or is wrong. If it's very, very clear, you will get a professional skill, a professional skill mark that you've made a judgment that it is wrong. Not that it could be wrong, but that it is very clearly wrong. They've applied the wrong treatment. You also need to challenge some information or assumptions. Okay, so challenge something if they've made an estimate that sounds wildly wrong, particularly if they've given you some kind of profit or loss data or SFP data. Only comment on the relevant amount. So if they've got £1 billion of assets, but this intangible is only 10 million, you assess it against that 10 million intangible. Okay, we don't completely blow out the scale. Only the relevant issue. And then be clear, is it over, under, or could it be both? If we don't know, could it be both? Okay, so if it's a useful life, we know it could be either, but if we know they've done it wrong, then we know whether it's over or under. So you have to be clear to get that mark. But what don't you do? You do not write the standard number. So for deferred tax, I do not write per IAS 12 income tax, right? Income taxes. I don't write that. I also don't write per IAS 12, per IFRS 2. I don't write that. I just need to tell them, okay? They assume we're applying the rule and that's all they need to know. Regardless of what the solutions say, okay? Yes, they always do it. They like them to look really good, but even you'll see it on the website. Do you need to reference a standard? Absolutely not. And don't overwrite about materiality. So if you've already calculated at the top, don't then say, because 300,000 is less than 500,000, because that's pretty obvious, right? So just say something like, this is material, okay? The incorrect part, the misstatement, whatever it is material, okay? And that is fine, because you've already got that materiality reference above. So, risk question specific. It will almost always these days state that you need to evaluate and prioritize the significant risks of material misstatement. Okay, so it's I'm just laughing because my cat, just seen my cat catch a bird. I can't do anything about it. And so evaluate and prioritize the risks. Prioritize means get those top ones, right? Don't talk about something that's really, really minor at the top in the planning of the group. So in this case, we've got materiality of 500,000, okay? I didn't want to give you all the detail. I wanted to make sure you've only got parts of it. So the scenario we've got, and I tried to highlight the bits so you don't have to try and read it all in one go. We basically bought a company. We bought 65% of the company. And the other 35% is not controlled by us, but is controlled by the government. Interesting little scenario, okay? Could have been something in FR, okay? So could have linked through to AA, but we bought a company and it should be that it's consolidated. However, they've added a complexity that the government have the other part, and therefore there's regulatory requirements around it. So what that means is very clearly at the start, we think we control that company with 65%, but you need to discuss why we might not. And therefore there's a risk that we didn't recognize it appropriately. Okay. So what they've done is they've consolidated, and they'll say the currency is in the same currency. They want to remove the valuation part of it and not get you to think, oh, they've got the amount wrong. Okay. But they want you to focus on that issue. Okay. So how do we write that? Well, we go back to our reference where we said before, how would we write this? The cost is material to the group, right? The cost is material to the group, right? But it's interesting because this is obviously going to affect a lot of things. It's a big thing because consolidation is going to affect loads of different balances. But it's material. There are other things more important. However, how do we talk about it for financial reporting? It has been treated as a subsidiary, which appears correct when we reference the 65%. However, remember we're talking about this could be wrong. The government owns 35%, which may affect our control. Therefore, consolidation is inappropriate. Now, I've told you to reference two things, but this was a really good scenario that deviates from that a little bit, in that you know there's going to be loads of things that are wrong. So what we do instead is say the consolidated as a whole. That's a massive thing. The consolidation could be overstated because we've brought in all the things into a consolidation. Not understated, okay, overstated. So it's a bit more unusual, but normally we'd have something, or regularly we'd have something where there's two different things we can reference. So again, it's not really complex, but we're saying, does that sound like it's okay? You need to tell them it looks okay or it could have gone wrong. And in this case, just bring in some subjectivity to it, something where you say it might be wrong. Okay, we don't know that it's wrong, okay, in this case, but it might be wrong, therefore challenge it. And that is what you would do, and that is enough for you to get the full marks for that part of the risk question. And then on to the next header and on to the next point. But very methodically going back to comment on materiality, comment on the financial reporting issue, tell me, therefore, X and X is overstated and understated. Audit tests, okay? Audit tests then. Tests have to be principal, right? This again comes back to what are the most likely things to be wrong, okay? So in a consolidation, I do not want to say, oh, they might have added them up wrong. Right? Very unlikely. Systems are going to do that automatically, or should. But what I want to say is, what could they have done wrong? What could they have chosen inappropriately to go wrong? What is complex that they might have got wrong? So management bias, subjectivity, and complexity are going to be things that I focus on. It doesn't mean there aren't important things, like the cost of the investment is important, but if there is a fair value element to it, that's going to be subjective. That's going to be something I need to verify. So bringing that in, right? Principal tests. And that is, again, where people can write tests, but not always address the fact that it's principal. Again, ding that professional skills bell. So what do I need to do? What am I aiming to do in my tests? Well, think about, is there anything I can review generally? Like, can I discuss something with them? Like, is there something I can discuss? And then think about the evidence you want to get, and be a little bit careful with written representations, just as caveats to start with. People love a written representation and they try and write more than one. In the end, we get one. So be a little bit careful in trying to ram that into every single question. But it does have its place. So how do you write a test? Right, I decided to add some color because I noticed my slide didn't have enough color. So what are you doing and what evidence are you looking at? Very commonly, we particularly aim at this. So I want to agree the cost. So agree is the what. The cost of the investment to the legal documentation is the evidence that I want to verify against. But my answer has to say why. I will not get the mark if I don't say why I'm doing it. I'm doing this because I want to confirm the amount is accurate, which sounds very, very obvious, but you have to say why. And this is where we have these assertions that you can come back to: completeness, classification, accuracy, and so on. Why are you doing that test? And you have to have both elements in order to get the mark. There are some exceptions to this slight rule, so like a written representation, okay, but you still say what and why. Okay, so you're obtaining the written representation to do something, discuss with management, and assess it's reasonable. It's a very common. And the other bit is, if you need to sample, be clear that you need to sample. You don't have to explain the practicalities of sending an email to management to ask them for the list and then doing that. You don't need that level. You need, is there a thing where I say sample, okay? So for example, if I was going to test, there was 100,000 different items, like if there was loads of revenue transactions, I don't say recalculate for all revenue, right? I need to say perform a sample, because that is showing your professional skill thing again. So let's give an example, right? Design the principal audit procedures for segmental reporting, okay? I said that in segments, right? That was not on purpose. Segmental reporting, right? Segmental information is a disclosure in the financial statements, right? But again, it's principle. There are some nice and simple financial reporting rules around this. So again, I've taken a little bit of extract from a real question. At the bottom left, you can see there's a segment, okay, segment in a segment, of the operating segments with 3 different parts to the cruises, okay? Now, if you know your rules, you go, right, there's definitely a 10% rule, and there's a 75% rule, and some other stuff in there, okay? But there's a clear risk that there's going to be inappropriate disclosure. But you need to know for testing, how do you verify those rules? So again, you need to think about the types of things you're going to be asking, and then how you're going to verify them, and then what else you need to do. So I've broken segment reporting down into a couple of different things. Number one is, who determines the segments? Well, I want to know, do management actually know the segment reporting rules? So the bottom one is, so the top one is, how are they determined, and who in the business then determines it and writes it in? So I want to look at the analysis they've used to determine the segments, because that might mean they're missing a segment. Okay, so there might be another part of the business that's missing from the segments and the analysis. But I also want to know the basis they use, is that following our IFRS rules? Is that following the rules that we know? Now, I wouldn't typically, and I'll put exclamation marks in, I wouldn't typically write 2 discussions in, but segment reporting allowed me to, because there's 2 different areas. But as a rule, I generally only have 1 discussion, because otherwise all your evidence is a bit weaker. So I start with, I need to see their basis and confirm it is reasonable. And I followed the same, what am I asking about? What am I looking at? What am I confirming, i.e. why? And then I think, right, now I need to look at what they've done. So confirm that each is at least 10% of total revenue, and they gave you the revenue figure and the segment revenue. So I didn't need to actually physically do that in a test, but in the risk question, I would have calculated that. So confirm that each segment is 10% of revenue. And then also I need to recalculate that all the external revenue, okay, all the external revenue is at least 75% of that. If not, they need to increase it. Okay? And then also the value of assets is also at least 10%, right? I didn't necessarily see that on the screen, but I'm then thinking there's a 10% rule, a 10% rule, and a 75% rule. Those 3 rules, along with the discussion, for most questions would have already got you that pass, because most questions are going to be about 8 marks for tests. So discuss it with them, 3 different tests, bang, done. But we want to go further. We want 100%. Okay, so another example is, I know there's reporting, there's a disclosure, so I want to review that disclosure. It is likely they may not have met the disclosure rules. So again, I'm thinking review the disclosure and confirm it's sufficient and adequate and accurate, okay, which is maybe a little bit overcooked, but I'm telling them why I want to look at their disclosure. And in this case, it's one of the only times you will use the financial statements as your evidence to review. Disclosures, you have to look at the financial statements. But what you don't want to do is review the financial statements for the value of the individual item of inventory, because it's inappropriate. You're not going to see it. Otherwise, financial statements for a company would be humongous. So again, doesn't feel as daunting when you're thinking, oh, segment reporting. I used to calculate that and do all that. It's not as complex when you're testing it. I feel like auditors, we get a nice easy job sometimes. So that is your segment reporting, and that is your tests. As we move through, the last two is quality control, okay? And then we've got reporting, okay? So audit reporting. But the two quality control questions is where we flip all that around. They could give you the tests they've performed and ask you, are they okay? Is there anything missing? That is effectively what they're trying to ask you. So again, it's being very, very clear. Is it right? Is it wrong? Is it enough? And then telling them what else they need to do. And it's very, very likely they'd have done stuff wrong and there's stuff that's missing. Okay, otherwise the whole question would be saying correct, correct, correct. The other part, which people get a bit lost in, is justifying the misstatements. That means where the auditor has found something, the examiner's given you that in an answer and said, I found this thing's wrong, tell me why it's wrong. And people go, it's wrong, right? They already know that, they gave it to you. It's in the uncorrected misstatement schedule. So it's again about showing off your financial reporting knowledge, okay? And we've got one of those questions. I haven't done both for timing, but I have done a question on justifying misstatements. So think about how important is that item? The main thing we're really talking about in this webinar is why is it wrong? Why is that misstatement there? And they give you information around it that gets you to explain why it's wrong. So it's very, very clear that you know it's wrong compared to the risk questions where it could be wrong. So explain why it's wrong is the thing we're focusing on. But in terms of broader context, when you answer these questions, you will tell them how important is it? i.e., is it a material misstatement or not? Because it's on a schedule of uncorrected misstatements, which includes material and immaterial ones. And then you might discuss a wider issue. So like subjectivity, it might mean they chose to do it wrong, which you'll see in a second. And then if the question doesn't have a reporting impact that follows it, you can actually bring a little bit about reporting, okay? But most questions we're justifying, then follow on with and assume they don't change them. What is the reporting impact? And I say most questions will then have some additional procedures you might perform, particularly with sufficient and appropriate evidence questions. But we're not covering that today. So how do we do these questions? Evaluate the matters that should be discussed. Sounds a bit more complex than just tell me why it's wrong, but that is what they're saying. And further actions, but I'm not covering that bit. So this is where, again, we've got a big scenario. I had to chop some of it down, but what we're really looking at is the bottom bit. There's a schedule of uncorrected misstatements. You can pause or take a picture of the screen if you want. There's a schedule and there's £25,000 that's wrong. Okay, so it's $25,000, sorry, that's wrong. And in particular, the reason, okay, the thing that's wrong is in the blurb below. It says they have investment properties and they use the fair value model, okay, but they said one of the investment properties had a investment value that was lower, okay, so they had to effectively reduce the value of that 25,000 by 25,000, but they said, no, we're going to use the other three at fair value, but basically because that one's gone down, I'm going to leave that one where it is. Now, let's be honest, we're probably going to guess that doesn't really sound like a choice we should have. So if you were stuck, probably you can guess that it was wrong, but you're not going to get all of the marks to be able to justify. So when you know it, okay, it's really nice and easy to explain. So this is where we have these asset rules that in AA were a bit more simple, but in here we've got investment property. Okay, particularly a revaluation was common in AA, but in here we've got investment property valuation, particularly fair value. So again, we don't need to read all that, but what we are reading is this bit. So let's start with materiality, which was my first thing I said in my approach. The uncorrected misstatement is below materiality, therefore is immaterial. So the $25,000, we had a materiality level that they'd given us already. So great, that saves me a bit of time, but just it is immaterial because it's 25,000, not because 25,000 is below 40,000, because that's pretty obvious. Boom, I've got one mark. And then we talk about financial reporting. And in this question, yes, you can choose, but you have to apply the same thing. You can't pick and choose. They call it cherry picking. You can't say, yes, I want fair value for all the assets that have gone up, but no, I don't want it for the ones that have gone down. So they're all, particularly if we're looking at asset classes, investment properties all need to follow the same. Therefore, it is incorrect. Okay, I know we already know it's incorrect, but be very clear, this is the reason why it's incorrect. So we've got the reason, we've got our FR point, points in this case. And then in this one, we've got a wider issue because it says they've used it and they've made a choice. I'm a little bit concerned as to why they've deviated from those rules. So I've gone even further with my answer, which isn't the case in all answers, but in this one in particular, it's likely fair value is more appropriate because the value's gone down. So that's, again, that's a bit of a judgment, being professional skill. But also using that is a lack of integrity. There's a suggestion that they want to keep the asset values higher. Really important if there's a suggestion in the question for something else, like they're listing soon, or they're renewing a bank loan, or something like that. That's a really good way to link in management integrity and bias. And it could extend. And in this case, I didn't expect you to read the whole blurb, but you might have clocked, if you're a really quick reader, that the bank covenant required a 6% profit before tax. And that is why management integrity was really important here, because obviously the write-off of the 25,000 could have affected that 6% profit before tax. And that's a wider issue. It isn't the case in all answers, but if there's something there, particularly with subjectivity, and we have a suggestion in the question, then we draw on that as well. And you may have noticed by now, I only have one animation. It is appear. It's not swooshing and all that other stuff. Okay, final one is reporting. We're talking about the audit report that they give at the end. There's one report, there is one opinion. It is always tested because one of the questions 2 and 3 will be reporting and completion, or completion stage. So we know it's there, we need to know what we're doing. Okay. Very commonly it says management won't adjust it. The reason for this is because otherwise they have to give you the mark for if they won't adjust it and if they will adjust it. Okay. So they're usually very clear that they won't adjust it. Also be a little bit careful if it says individual versus aggregate impact. Okay, again, 2 different things. But what we're going to talk about is their approach, and then we're going to go into a question specifically. So we've got a financial reporting issue. So discuss it very much at the start. You could start with materiality, but what we're really saying is, what is the problem that we see? So what has happened? Have they made an error? Or actually, do we disagree with the judgment? So they've chosen a useful life. They've chosen to record an investment property incorrectly when the other 3 they've recorded correctly. Only describe that individual amount that's wrong. Okay, we want the individual amount, not blow it up into everything else, because that's the misstatement. Number 2 is there any wider issues? Like in the last question, we had a wider management integrity issue, but that's not in all questions. That is, let's say 1 in 4, you might have a wider issue point. Then confirm, is it material? Okay, is it material by its nature and or by its amount? Most commonly, it'll be material by amount, but some things can be immaterial. Okay, related parties we know are things that can be by nature as well, among other things. Then state if it's pervasive or not, but do not do this if it is not material. It will never be pervasive, because that's our baseline is material, and then up here is pervasive. So if it's not 100, then it's not going to be 200. So confirm if it's pervasive, if it is material. Okay. And then finally, what is the then the impact? Is it affecting our report? Is it qualified, modified, except for all those words that you need to get your head around? So be very clear, right? Did it stray from an error, disagreement, lack of evidence, right? And how has that flowed through? Be very, very clear in that report. And ideally, state how it affects the basis of X opinion paragraph. Okay, so is it a qualified opinion paragraph, an adverse opinion paragraph, or a disclaimer opinion paragraph? Okay, that's a good thing to have as point 6, or point 5b. So a question, very common question, evaluate the implications on the report, okay, assuming no further judgments are made, okay. So basically we've got a lease, okay. So I said there was a lease question coming up. I don't need to know that much about leases in order to answer this question. Okay? Obviously you need to know something. Yes, you need to review the rules, but had that kind of exam panic, there's still things you can address. So we've got our approach, which means we can follow it. Number one, we've got another scenario, okay, because I tried to pick lots of distinct FR issues. Management has not charged any depreciation on the right of use asset, stating the rent-free period should not result in an expense, i.e., for the first year, they have not charged any depreciation. Now, again, you're probably going to make a guess that it's a 6-year useful life for this asset, or 6 years, sorry, that they're paying for the asset for lease purposes, and they've decided not to charge anything in the first year. Well, make a judgment. Does that sound right or wrong? Yeah. Most likely it's going to be wrong, isn't it? So they haven't charged anything. They've got this 6-year life that they're using. So let's talk about that initial treatment. The initial treatment, okay, so the initial treatment appears correct. In full, it would be because it's measured at the present value of the lease payments, right? But the depreciation and useful life assessment are incorrect. Okay? So I want the initial treatment is correct, but the depreciation and useful life is incorrect. Explain to me why. Because the rent-free period affects the timing of cash flows, but not the useful life or need to depreciate it. Okay. That's where I'm going straight in. I haven't done my materiality yet. I could have done it at the start, but then I'd have to explain why I've commented on an issue by being 4.1 million wrong. So most of the time it flows nicer to talk about materiality after. So depreciation should have been charged for 4.1 million. That whole amount is wrong. Okay, it's not part of it. We know the future years, they could have been slightly wrong because it's been spread over 6 rather than 7 years, but we know that there's nothing in year 1 for depreciation. So the whole 4.1 million is incorrect. Again, taking a leap of faith with that, you could have calculated it over 6 or 7 years and then said whether that was material, and you'd still get some marks. So we've got that 4.1 million. Now we need to talk about the reporting impact. It is material, okay? We would know that, and we might have to reference why. So it might be because it's 10% of profit before tax, something like that, okay? So you might have to state that if it's not already calculated for you, but in this question, it was. So it is material. It's not considered pervasive. Again, it is material, which means I need to talk about pervasiveness. It's not pervasive because it relates to a single lease and doesn't have a fundamental impact on the users. Now, the typical way to describe this is it doesn't have a fundamental impact on the users. To me, that doesn't really explain why it doesn't actually classify as pervasive. It doesn't affect more than one area. Well, double entry affects more than one area. So technically, everything would affect more than one area. So just be a little bit careful with your description of something being pervasive. The audit opinion should be modified. Okay, it will show us the financial statements are true and fair, except for the material misstatement, okay, outlined below in the basis of qualified opinion paragraph. And then for bonus points, the material misstatement will be explained, including the reason and the quantification, i.e. the 4.1 million. And all of the description that I've just shared is what would be then copied and pasted into the reasoning and elaborated on with a very, very clear statement of which IFRS rule it breached. But we don't have to do that bit and write it all out again. So very, very clear approach. Again, discuss the issue, discuss if it's material, discuss if it's pervasive, then tell me if and how my report would be modified. Even if it's not modified, tell me it is not modified. And then the bonus, but we should have time to do it, is the basis of XX opinion paragraph. So that, in a nutshell, is all your questions, okay, in one go. So that's your risk question, your tests questions, that's your quality control question. I only covered one type of them, and then also your reporting. So what I think you need to really take away, risks require depth to your financial reporting. It is the middle chunk and likely to get you most of the marks. So likely to get you, let's say, 2 out of 3 of those marks. Tests have to be professional. What? Why? Quality control questions, so evidence, justify misstatements, be very specific and explain the issue. Don't just state it's wrong because it's wrong in the text, in the misstatement list that you gave me. And then reporting questions are methodical. They are follow the same structure over and over and over. So if you want to know more, some really useful things I think you should use. Mind of the market is great. Okay, the mind of the market gives you effectively a pass and a fail answer. Okay, on the exam technique page, they're not always the easiest to find. Examiner reports are great, particularly for telling you why things are wrong, why students got things wrong, didn't get the marks, did well. Okay, including that materiality assessment. AAA have an examining team page, again, exam technique. There's a few good tips in there. There's some are pretty simple, but actually there's a few where they're really good reminders. And then the AAA mock exam and debrief video is done by the ACCA. So it's them giving you a nice debrief rather than you reading the answers and the solutions and trying to interpret them, which you should still do anyway. But when you've got a mock exam and a debrief video, it helps a bit more, hopefully in the same way that this helped a bit more. And then voila. Okay. Any questions? Of course. Let me stop sharing and I will also close the webinar for any other questions. Thanks for listening.